Okay. I want to thank everybody for participating in this special session to review the historic market movements due to the COVID-19 pandemic. Since the start of this pandemic, we have received a large number of questions, many of them following common themes, so it made sense for us to hold this special meeting to try and address these questions. We were able to combine many of your questions because of the common themes, and we will spend time addressing them at the end of this presentation. Please take note of the title, 2020 So Far. So far are the operative words. The world is changing quickly, and there could be many more significant events before this is over. Some of those events could even be more dramatic than what we have seen so far. I also want to note, this is not a run-of-the-mill economic downturn. One difference, many lost jobs will not simply return when the economy gets better. How we deal with that will mean we realized an opportunity or lost substantial portions of a couple of generations of our society. We will give you our view on what has been driving the market movements, but appreciate that any views anyone gives on this are underpinned by assumptions about the future. Unfortunately, no one has a crystal ball as to what the future new normal will actually look like. However, the longer this goes on, patterns are developing. Many psychologists believe it takes 4 months to form a new habit. Unfortunately, it looks like the strange 6 months we have already experienced will continue for another 6 months before a vaccine is available, and I believe one will be. That would seem like plenty of time to form new habits. We will start this presentation with an overview of how the markets have responded to the COVID-19 developments. Well, what it all means is subject to great conjecture. It is unquestionable that the market movements themselves are historic in magnitude. For example, we went into a bear market in March of 2020, meaning a drop of 20% in 16 days. That has never happened in the history of the US stock market. As we look at the market's response to the impact of COVID-19, I will ask you to look for 2 types of events. The first, those that are an acceleration of trends already in play. I think many of the current trends have been a little bit overlooked in what has happened so far. The second type of event are events that are totally new and were completely unexpected. While the final settling is probably far from complete, both types of events will play a part in what will eventually become a new normal. Here are a few disclaimers in our presentation. We always have to put these on the screen for regulatory purposes. The information here is from public services, and we believe it's reliable. But as we can all see, this environment is changing by the day. In fact, since this presentation was put together over the last couple of weeks, substantive changes have already developed. And remember, this year is not over, and this pandemic is not over. There could be a few more major surprises. As per usual, this presentation is not intended for personal tax or investment advice. That kind of advice can only be made in the context of your personal financial objectives. Now, Kevin, I would ask you to start walking us through some of, from an investment perspective, what has happened in 2020 so far.
Sure. Thanks, Milt. And good afternoon, everyone. We appreciate all of you joining us today. Here's a summary of what I'll be covering in this presentation. As we normally do, I'll start with a brief recap of market results, and we'll look specifically at some of the key events that have been driving the market over the past several months. I want to summarize the fiscal and monetary actions that have been taken in response to the pandemic. which to some extent have been unprecedented. And then in times of market upheaval like we've seen this year, there are always winners and losers in the corporate world. And while financial strength is often a key factor, we're finding that this pandemic is bringing some fundamental shifts in behavior that are also playing a role in relative performance. So we'll talk about that. And then an issue that is probably on many of your minds is the upcoming presidential election. And we have some interesting data to share about elections and market performance. And finally, Milt will tie this all back to our approach to investing in your own investment portfolios with what we refer to as the winner's bias of index investing. Now, I want to just mention that since we're not in a face-to-face setting today, I would prefer that we hold questions to the end. However, if you do have a specific question on one of the slides, Brianna will be monitoring the chat box. So if you want to go ahead and type that question in, we can cover it if it's specific to some of the information we have here. So with that, let's go ahead and get started. This first slide provides a recap of some of the major market indices through 2020. And in this case, we're actually looking at some pretty unique time periods here. The first column shows results from the beginning of the year to February 19th, which was the pre-pandemic high for the S&P 500 index. You can see here that performance in the US was actually pretty strong, with close to 5% growth in the S&P 500 in just the first 7 weeks of the year. You can also see, however, that international developed markets and emerging markets were more tuned into the coronavirus at this time, and those indices are already starting to turn negative in that period. The second column shows the time period between February 19th and March 23rd, with March 23rd being the low point of the market through this crisis. And here you can see the dramatic impacts of the pandemic on all markets, with reductions in the low to mid 30% range for all the major indices. And I should point out that mid-cap and small-cap stocks, which aren't listed here, lost even more value during this period. And to put this in perspective, one has to go back to the Great Depression to see market declines of this magnitude over such a short period of time. The third column then shows returns from that low point on March 23rd through early August. And the numbers here are almost just as mind-boggling, fortunately moving in the positive direction. And again, you'd have to go back to the Depression era to see market gains of this magnitude in such a short period of time. So if you look at the year-to-date results in the last column, you can see that bonds have done well, which is not unusual when the stock market goes through a sharp correction. But perhaps more importantly, the stock indices in the US are currently above where they started the year. They haven't gotten back to the peak in mid-February, but despite all of the upheaval of the past several months, the returns are positive for the year at this point. Now, before I leave this slide, I want to highlight the performance of the technology sector, which is reflected in the NASDAQ returns on the bottom row. Performance in this sector was quite good before the pandemic, but performance through the pandemic to this point has been nothing short of phenomenal. And we'll talk about that a bit more in a few minutes. So with this as a backdrop, I want to focus on some of the key events over the past several months and their impact specifically on the S&P 500. This slide provides a timeline view of the S&P 500 index and some of the significant pandemic-related events that I've put in here. To provide some overall perspective, the 4 red dots that you see represent the dates that I was just referring to. The beginning of the year, the market peak on February 19th, the bottom of the market on the 23rd, and then where we were as of last Wednesday, August 5th. I'm not going to hit every point on this graph, but I want to highlight a couple of the key drivers during the crisis period from mid-February through most of April. The decline in the US really began as the virus became more widespread in this country, and more specifically with the first reports of community transmission. This is when the uncertainty and fear about the virus really started to impact the markets. Governor DeWine's cancellation of the Arnold Sports Festival on March 3rd was a pivotal moment because it triggered a cascade of other cancellations, including most professional sports and the NCAA basketball tournaments. And that, combined with a travel ban from the European Union, which was announced on the 11th, really added momentum to the market decline. Now, in the following week, the federal government initiated a massive response to the crisis, starting with the Fed's reduction of bank borrowing rates to near 0% on March 16th. And this action, combined with discussions in Congress about a large fiscal stimulus package, led to the market turnaround that began on March 23rd. And really, as you can see, the S&P 500 has been on a steady upward trend since early April. And I want to touch on some of the key drivers of that trend here on this next slide. Once again, we have a number of data points here, but I think the market improvement since late April can be attributed to three broad trends. First, the gradual reopening of the economy, which brought some very positive news on employment and retail sales in the month of June. Secondly, significant progress on coronavirus therapies and vaccine trials, including positive news about the treatment therapy remdesivir in late April and Moderna's vaccine trials, which were announced in mid-May. And then the third thing is the positive impacts of the massive sort of monetary and fiscal stimulus that were provided by the federal government. I also want to highlight again that a common theme throughout this recovery has been the stellar performance of technology stocks, particularly large cap tech stocks like Apple, Amazon, Google, Facebook, and Microsoft. We'll talk more about this in a few minutes, but the significance of this technology growth should not be overlooked. I would also note that a recent resurgence in coronavirus cases is likely to be weighing on stock values to some extent right now, as some aspects of reopening have been paused and significant uncertainties remain about kids returning to school in the fall, which could make it difficult for some to return to work. Although this is cause for some concern and could significantly impact certain parts of the country, we do not expect to see a repeat of the type of nationwide lockdown we saw in March and April. So with that, now I want to spend a couple minutes talking about the economic policy response to this pandemic. And I'll start with the Fed's monetary policy initiatives. Quite frankly, there are more here than we have time to mention. But I think it's safe to say that the Fed learned from the financial crisis we went through in 2008 and 2009, as they've taken some unprecedented actions to support the economy during this pandemic. The first item you see here, reducing bank borrowing rates, is a common response to economic recession. And we saw many of these other initiatives during the Great Recession as well. Other actions, however, like direct lending to banks and the purchase of corporate bonds, are somewhat unusual, and they indicate the very significant efforts by the Fed to avoid a crisis in the financial system. Naturally, this level of support is welcomed by investors, but it's something that cannot be sustained indefinitely. Let's talk for a minute about the fiscal policy actions. As powerful as the Federal Reserve is, this crisis also demanded action from Congress, which has come primarily in the form of the CARES Act. Again, I'm not going to go through these items in detail, but to get a true appreciation for the size of the stimulus provided, consider the following. The stimulus bill passed in 2009 in response to the Great Recession was $831 billion, or only about 40% of the size of this package. The CARES Act stimulus exceeds the amount of U.S. government spending on all discretionary items in the most recent fiscal year, which was about $1.3 trillion, and is more than half of total federal spending in a normal year, which is around $3.5 trillion. And when you consider that the budget deficit was already projected to be more than $1 trillion before passage of this bill, the U.S. will report the largest peacetime budget deficit in history by far this year. This additional spending, combined with the contraction of the economy, has increased our debt to GDP ratio to more than 130%, which is the highest ratio we've seen since World War II. And keep in mind that we likely have not seen the last of the fiscal stimulus, and very little has been done at this point to plug the revenue hole that has opened at the state and local government level. So it's on the fiscal policy side, I think, where the federal government is really getting into some uncharted territory. They're trying to address in the near term a public health crisis that can be economically devastating without endangering the long-term financial health of our country. And given the current political climate in Washington, D.C., I think that's an immense challenge. So while you're digesting all of that, I want to shift gears a bit and talk about some of the dynamic shifts we're seeing in the markets as a result of the pandemic. Unfortunately, with a market shock like this, there are inevitable winners and losers, and that certainly is the case this time around. However, in this case, it seems the shift is more significant and likely to be more permanent as well. In some cases, the trends we're seeing were already underway before the pandemic and have accelerated as a result of the lockdowns. And this certainly is the case, for example, with the retail sector. We're also seeing a shift from live events to digital entertainment like gaming and streaming services. Live events will undoubtedly recover, but perhaps not to the level they were at before the pandemic. And of course, the travel industry has been decimated, and the recovery in this industry is likely to take quite a long time. So part of the message here is that the coronavirus has accelerated a sort of rotational shift in the economy. But I think another important takeaway is simply the inability to predict global events and how they might impact companies, sectors, and the markets as a whole. So let's talk a little bit more about technology specifically. I mentioned the impressive growth in this sector earlier, and initially there were some thoughts that this growth was creating a technology bubble. However, it's evident that a large portion of this growth can be explained by superior financial performance. So far in 2020, Amazon, Apple, Facebook, Google, and Microsoft have outpaced the S&P 500 in both revenue growth and earnings growth. They have much stronger cash positions and much wider profit margins than other companies in the index. It's our opinion that this represents much more than an investment shift towards stronger companies. We're seeing a type of industrial revolution that may be a strong harbinger of what the new normal looks like. As Milt mentioned earlier, new behaviors can take hold in a period of months. And in this instance, many old-line companies in retail, entertainment, travel, and other sectors simply may not survive. So with that, I'm going to turn to another topic of interest, and that is the presidential election. And what we have here is a chart from Fidelity Management and Research that looks at presidential elections throughout history and how the markets have performed under those administrations. Now, the first thing you can see here is in the chart on the left is that historically market performance has tended to improve as we move through the 4 years of a presidential term. The chart on the right is a bit busy, but I'll try to boil it down. For each set of bars that you see here, The dark blue bar represents the first 2 years of a presidential term, while the light blue bar shows performance over the entire 4 years of a term. And historically, what we can see is the market results from a Republican presidential term are, on average, virtually the same as the results from a Democratic term, although there are some differences in growth rates when the terms are split into 2-year periods. And the same is true when one party sweeps the White House and both houses of Congress. Again, the 4-year result is very similar, but there are differences between the first 2 years of a term and the last 2 years. The only measurable difference over an entire 4-year term historically is when there has been a divided government. In these cases, the Democratic Party has done better over both the first 2 years and the entire 4-year term. If you look at these results as a whole, they're really not surprising. Stock prices are based on expectations for long-term earnings and growth. So when actions are taken to boost markets, it usually just creates a timing difference, not a change in how the long-term market is going to perform. In other words, you can move benefits up or push them back, but it's very hard to create permanent changes or sustain economic conditions that create long-term impacts on the stock markets. Now, the upcoming presidential election, of course, is very important. In such a partisan political environment, it's easy to see how this election could be seen as a significant market mover. Nevertheless, after looking at this historical data, our sense is that the 2020 election will have less long-term impact on the markets than some would suggest. Ultimately, it's the long wave of economic fundamentals that drive the markets beyond any one election or any one party. So with that, I would like to turn this back over to Milt, and he's going to tie this back to some of our views on investment management. Milt?
Thank you, Kevin. Okay. I want to look at the winner bias of index investing, and let me walk through the sort of resiliency of the index investing even in this environment. Okay, I'm getting a fair bit of feedback, and we certainly don't need to hear this twice. Whatever feedback there was, it looks like it left, so okay. I'm not sure what I did there, but I apologize for the echo. Okay, let me start here. Okay, what we want to do is we've got a slide here, and I want to start with the slide with an observation that many of you may have already noticed in this pandemic. Companies that are doing well are doing very well, and companies that are struggling are doing very badly. These extremes make stock picking much riskier than normal times. For example, if you're holding 10 stocks that you think are going to be winners in the new normal, and you get only one wrong, it will likely nullify the gains of the other 9. So how does index investing mitigate this extremely risky environment? Before I answer that question, let me provide a couple of basic data points about this slide. This is a chart that we've used in the past that shows the growth of US passive investment results compared to 3 well-known types of active management: hedge funds, US active mutual funds, and US private equity. On the vertical axis is the yield percent, and on the horizontal axis is the cumulative annual asset growth rate. As this chart shows, only private equity investments yielded more than passive investments between 2009 and 2018. However, private equity investments are known as illiquid investments. That means you cannot withdraw money, in this case sometimes for years at a time. And most problematic, not when you need to, only when the private equity fund managers allow it. While the extra yield can be beneficial, not being able to have a predictable cash flow limits the usefulness of private equity as a retirement investment vehicle. The bottom line is, compared to liquid investments suitable for retirement investing, passive index continually outperforms. So let me go back now to my original question. So how does index investing mitigate this extremely risky environment? It's actually quite simple if you think about it. By their very nature, index funds have what we call a winner's bias. An index has an automatic rebalancing mechanism that amplifies good results, while poorly performing companies have their results becoming less significant in the overall index yield. So in other words, the good is magnified and the bad is dropping out. Now that completes the basic presentation. We have received several questions, and I think and we may have received some questions during this presentation. So Brianna, can we go back to you and see where we stand?
Sure. So like Milt said, we did have a few questions submitted prior to the call, and it looks like we might be receiving some in the chat box soon. So we're going to try to make sure we get them all answered. The first question that came in prior to the call was, the stock market has largely recovered and the losses it suffered in February, March, but the pandemic is still with us. Are stocks overvalued?
Okay, let me answer that question. Before I get into some of the specifics on this question, it's certainly a very complicated question. There's many aspects to it, and I do want to emphasize that we are not out of this pandemic as yet. So again, the answer is so far. But I want to start by revisiting three items that Kevin mentioned. Number one, technology has picked up a great deal of the market share since the pandemic started. And as Kevin mentioned, much of this switch to technology was already underway. I mean, realistically, you could say some of the switch to technology goes back 30 years. However, the magnitude of the switch that's now been basically forced on us through COVID-19 is nothing short of unbelievable, frankly. It goes back and it makes me think of the Industrial Revolution. Now, if you follow or remember from your history classes, the Industrial Revolution, starting in the mid 1970s, lasted more than 120 years or so. We're being forced to make changes that are much more rapidly. Relatively speaking, they're staggeringly fast, and I think it's going to be a reflection on us as a society and how fast we can adjust to this. So fortunately, technology, the technological tools to shift to some of this remote functioning or functioning in isolation were already working. So that has been accelerated enormously. And as Kevin identified, this is being reflected not just, maybe there's some optimism that creates a bit of a bubble, a market bubble in technology, but much of this is now being supported by increased growth and increased earnings that are in fact likely to continue. So technology is certainly carrying the market. I will also mention, not all retail is failing. And I will mention a very specific company called Tractor Supply. Many of you, particularly if you live in a rural area, may have heard of this organization. Tractor Supply is to much of rural America what I don't know, Target is to urban America. The name is misleading. They sell much more than tractors, but it does have a farm equipment bent. But they also sell kayaks, and they sell crafts, they sell canoes, they sell fishing equipment. And many of those items that I just mentioned are items that can be enjoyed and used basically in isolation. And so while much of retail, brick and mortar retail, is shrinking, Tractor Supply has literally hired thousands of people, and they're still looking. So it is, again, the winners are winning big and the losers are losing a great deal. So technology is definitely carrying the day. The other thing that I will mention is the Federal Reserve and government actions, meaning monetary and fiscal policy. Many analysts believe that the economy is not in sync with the stock markets, but I think many of them are overlooking what the Federal Reserve and the government is doing to basically backstop the markets. It is unprecedented, the level of support that they are providing. And it's, there's no, I mean, I remember back in my economics class many years ago, what we're doing now, we're only identified as theoretical suppositions that someday could happen, but probably never will. I mean, the magnitude of the intervention is truly stunning. Now, can the Federal Reserve and the government do this forever? Absolutely not. Can they go to what takes me to the third item? Can they go until a vaccine is available? Very possibly. So if we see a vaccine identified by the end of the year or in the first quarter of 2021, and then there's a broad vaccination by mid 2021. Can we get through this? I will put a qualified probably on there. If the vaccine and treatment fall flat on their face, is there going to be a major stock market drop? Highly probable. So I would say those three factors certainly can explain why the market is propped up as well as it is. But even that won't last forever, and there are many contingencies that could step in and affect the markets and the economy in general, which the markets have not and are not anticipating, that could cause continued substantive volatility.
Yeah, and I guess I would just maybe add a little bit to that. I think one of the things that we tend to look at very closely with respect to whether the market is appropriately valued is the PE ratio. And that picture is very cloudy right now because of everything that's been happening over the last several months. What really are company earnings? And looking forward, a lot of companies have simply suspended their guidance for their earnings expectations going forward. So I think to some extent, we need to get through this period that we're in right now and kind of see, as we've been talking about, who really are the winners and losers, and then evaluate from there.
Okay, Kevin, there's another question here that kind of segues that maybe you could add on here. With interest rates as low as they are fixed income investments still a good option?
So that's an interesting one, and actually, if you go back to the slide that I showed at the beginning of the presentation, it showed that the aggregate bond index year to date for 2020 has actually outperformed the S&P 500. So aggregate bonds were at about a 6.3% rate of return. The S&P 500 had about a 3% rate of return year to date. We continue to believe that fixed income is an important element of a diversified portfolio. And we look at that as not so much a way to generate income, but more as a management of the overall risk profile of that portfolio. And we've seen through this pandemic, as we've seen in a lot of other significant market downturns, when the stock market is struggling and not performing well, the alternative that comes to mind first for most investors is to put that money into the bond market. And so it is also from a correlation standpoint, negative correlation standpoint, it is a good and important element of a portfolio.
So are there any specific planning issues that we should be considering in this environment?
Well, certainly we've had lots of planning meetings with our clients since this all started, and I would say, yeah, there are some themes that have come more into play in this environment than might typically. One of those is liquid cash reserves, and just thinking about how much emergency funding to have on hand that's not in the investment market to support your everyday needs. If you're in a situation like many people are today where one member of the household may have lost their income. And so that certainly is one, and we've talked to a lot of folks, those who are homeowners, about using a home equity line of credit as one way to provide that additional sort of financial safety net as a way to build those liquid reserves. Unfortunately, something like this does also bring up issues like life insurance, like estate planning, making sure that beneficiary designations are what you want them to be. But we've also gotten into, some areas that you really wouldn't have thought would come into play, like, for example, thinking about college planning. It'll be interesting to see what happens with sort of the higher education market in the United States. And I think, like a lot of other industries, there is going to be a shakeout in colleges and universities, and how that impacts, planning or the types of conversations that people are having with their children certainly is more in play now than it was 6 months ago. And then the last thing is just, tying it all back to portfolio management. And obviously we've had a lot of conversations with folks about their portfolios, and often those conversations refer back to, well, we have a financial plan, and the financial plan and the investment strategy are very closely linked, and so that has guided a lot of those discussions on the investing side as well.
Going back to those low interest rates, and we've been getting this question quite a bit from clients. Should they be refinancing their mortgage?
Well, yeah, we certainly have been getting that question, and certainly, we think it's a good idea when mortgage rates are being reduced significantly for whatever reason. But certainly in this case, I think the 30-year mortgage rate at one point dipped below 3%, and it may be back above 3% now. But the fact is that, yes, mortgage rates are getting very attractive. And so it doesn't hurt to look at refinancing your mortgage. One thing that we have found with our discussions with clients is that the cost of refinancing has gone up significantly. Closing costs associated with the refinance, we've heard numbers in the $5,000, $6,000, $7,000 range to close on those loans, which is significantly more than what we typically see. And so obviously that's something that has to be looked at when you're evaluating the interest savings that you would get from refinancing versus the upfront cost. And then the last thing I would say is, sometimes there's a temptation when mortgage rates are this low to shorten the term of your mortgage, to go from a 30-year mortgage maybe to a 15-year mortgage. And certainly, that is a way to reduce your interest expense over time. We do tend to caution our clients about doing that because it does also lock you into typically a somewhat higher monthly mortgage payment. And so as a way of maintaining your financial flexibility, we often will look at whether it makes sense to keep the 30-year mortgage term, but then aggressively start paying that down, assuming that there's no penalty for early repayment, so that you have the ability to shorten the term of the mortgage sort of on your own terms. And that if there is something that comes up like what we're in right now that has an impact on your overall household finances, you've got some flexibility to drop back to whatever that 30-year mortgage payment might be.
Thank you, Kevin. Let's see. Milt, maybe you could tackle this question. This question states, the federal government has increased deficits and debt significantly during the pandemic. Do you expect any long-term implications from all this borrowing?
Certainly there will be long-term implications, and most of them are not positive. This is one of the issues that will probably be most difficult to deal with going forward. There will undoubtedly be, once this pandemic passes, there will undoubtedly be some looking back, for example, and scratching our heads and saying, did we need to do everything that we did? I personally think the answer to that is yes, but it's undoubtedly going to be a question. So as Kevin mentioned earlier, the U.S. is approaching a federal deficit to GDP of around 136%. Again, as he mentioned, we haven't seen anything like that since the World War II, so never in peacetime. Now, the issue we have with the deficit is the deficit was beginning to balloon before COVID, and we were not, as a country fiscally, we did not have sufficient safety margin to deal with this in a non-deficit way. And if we break the deficit down, while COVID has been substantial, it has had a substantial impact in 2020 and probably will going forward. As significant an increase in the debt as that is, the real major underpinning of the deficit is Social Security and Medicare. And that has not gone away. So in effect, what we're actually doing is layering on what I'll call the emergency debt associated with COVID-19 into a problem that was already there. So like so much of what's happening right now, here's another trend, in this case quite negative, that we're accelerating. And that is, how are we going to come out of this? Now, typically when we look at high debt levels, what we actually see behind it or anticipate is inflation. And we thought we would see it with some of the solution to the Great Recession in 07, 08. But inflation never came. And the expectation as to the reason why is because we're in a environment, the US is in a very privileged position of being the global currency. And so that global currency allows the US to borrow at interest rates that are basically unprecedented in the world. And for example, using high deficit levels and inflation, we do have a country that's looked at quite frequently in Japan. Japan has GDP to deficit levels of about 230%. They are the highest in the world, certainly among Western economies. And Japan is in its entering its fourth decade with basically no inflation. So if oddly, with the deficits that that are going up as they are, economists are looking at Japan and saying, well, the US can probably absorb quite a bit more than they have. But anybody who manages credit card debts and everything else, which we all do, you've got to ask yourself the question, how much debt can we actually pile on? And that's an unknown, there's not an answer to that right now, but there is one substantive difference between Japan and the US in terms of debt levels. The Japanese are much higher savers than we are in the US. And so most of Japan's high debt levels is funded by their own citizens and their own institutions. Whereas I don't know the exact percentages, but I think 50% of the US debt levels are funded by non-US entities, primarily governments, anywhere from China to the UK to Germany, Mexico. We've got a lot of foreign entities that own and support our debt levels. And for those who are eager to close US borders, you have to wonder if we get too aggressive on sort of withdrawing from the global economic picture, will they continue to line up and loan us money? That's an unknown question. But I mean, is there a way out from the debt levels that the US is running up? Yes. But it does imply some fiscal discipline that heretofore, and I'll define heretofore as the last, let's say, 15, 20, 30 years, we haven't necessarily demonstrated an ability to do that. So it's concerning. And how exactly we work our way out of this at this point in time, I would not venture to guess, but certainly economists will tell you we could go even higher before we have a problem. I mean, I'll close with this. It's a hard answer. It's a hard question to answer, but fundamentally, we can absorb debt until we can't. And then unfortunately, it's not something you can immediately get rid of in any sort of structured or reasonable way. So it's a complicated question, and it doesn't look like the answer, it doesn't look like the problem is going to surface immediately, but it's got to nag people at the very least.
Okay.
That's all I'm going to say.
Okay. So let's switch gears here and let's talk about the unemployment rate. The unemployment rate is still very high. Some analysis actually indicates that there are aspects that make it even worse than it appears. Somebody asked, how will a recovery occur until unemployment returns to lower levels?
I'll grab that as well. This again is going to be one of the significant carryovers, I think, from COVID-19. And this is the one item more than any other, I think, that makes this an atypical recession. Most recessions, they end and people go back to the employment they had, and business picks up again. For many sectors of the economy, that's simply not going to happen. Restaurants are closing at an enormous rate. So are other smaller businesses, hair salons, nail salons. I mean, you name it. Anything that has personal contact may be compromised for quite a long time, even after a vaccine, which we may get into a little bit later. But how we handle this unemployment and this change, this historic change that is taking place, I think is going to be something that in large measure determines how, as a society, we function. And again, the Industrial Revolution is something that I've gone back to a couple of times. That took place over 100, 150 years, where we displaced large numbers of people. Now we're doing the same thing in literally months. And what we really are going to need to do is as a society, I think, make a decision. Are we going to help retool these people, re-educate these people in terms of occupations that are and can go forward in a more socially isolated society, or will we not? I mean, typical and historically, economists have looked at unemployment as something that was self-solving. Meaning, from my early economic days, there was basically a belief that everybody will act in their own best interest, and when their jobs are compromised, they will automatically go out and do what they need to do to re-educate, retool themselves to take on a new job. Well, what we have seen is that doesn't necessarily happen. It certainly doesn't happen very smoothly. And in some cases, it doesn't happen at all. So we're going to have to look at that very, very carefully. Now, we've added the additional burden that we've got governmental, federal, state, city, municipality, under very severe fiscal constraints. So it's going to make that even harder. But there's no doubt economically, it is better to get individuals that are displaced back in the economy. There's no doubt about it. However, there is one thing that I think I will close on while I'm not, again, particularly answering the question. I don't know how we're going to handle this. But as it relates to investments themselves, companies are very clever, and I'm saying that in a positive way. They know how to make money. They know how to make profit. They know how to keep their clients happy, and they know how to do that profitably. So. That doesn't mean the markets are going to not function anymore, or companies are necessarily going to do badly. I mean, I know that can sound very harsh, but I think there's some realism to that. So I admit it's a bit of a non-answer, but I think I am identifying, at least directionally, the kinds of things we're going to have to face. That's it.
Okay. We have another great question here, Milt. What do you think will happen in the markets when a vaccine is approved?
Another good question. I've kind of evolved on this particular point. And when this first started, I believed a vaccine was basically the cure-all and end-all to this, and I pulled back from that as time has passed, and I've read more about what the vaccine entails. I mean, there's some very good news relative to the vaccine discoveries itself. The global coordination that is working on the solution, the vaccine and treatment, is unprecedented. It's absolutely unprecedented. The sharing of information, and again, technology is the facilitator of this. So technology steps in again, and that's a very positive thing. The other positive thing about this vaccine is, my understanding is, this particular vaccine, this particular disease is very related to some vaccine scares or pandemic scares, virus scares we've had over the last decade or so, in terms of SARS and MERS, and I think a couple of others, that this is very, very similar. So there were organizations that were working on this particular type of virus that also, I think, gave us a head start. We're not starting from zero on this particular vaccine. So now those are all positives. Now here's the negative that seems to have developed, at least in my mind. I think the negative was always there, but it's become clearer. Many experts believe we will not have a vaccine that is 100% effective. In fact, we may start out with a vaccine that's only 70% effective. And the implications of that, combined with many people, there are some estimates that many people may not get a vaccine, get vaccinated, because they concerns about the vaccine itself and the speed with which it's been developed, and some possible side effects, as well as people who think it's not going to impact them very much. So if we end up with a vaccine that's 70% effective, and then have a vaccine that's only 70% used, or the vaccine only gets to 70% of the people, that may not be enough to stop the spread of COVID-19. And if that occurs, the implications are extremely significant. And so again, I seem to be very good at not answering questions, but at least I hope I'm putting the issues that at least as I see it, are out there. But if we don't nip this in the bud, there's an interesting study that's starting to materialize as well. And before I tell you what this study is, I will ask each of you, I know you can't answer me, but rhetorically, who do you think the group that I'm talking about actually is? Okay, here's the study. The study says a lot of individuals are not returning to the marketplace. I mean, there's a segment of the population that's not returning to that's not in the marketplace. They're not going to restaurants. They're not getting on airplanes. They're ordering their food in. They're by and large enjoying contact virtually, et cetera, et cetera. And this segment of the population, estimates are placing that there are 5 to 10% of the economy. Now, some of you, it's probably already the light bulb has gone on. That's us. It's people who are older, who are immune compromised, and it just so happens that many of those people have reasonable discretionary income, and they're not spending it. So you can create all the tax incentive you want. You can pay people money, but until you can make people safe, at least feel safe, they're not going back into the marketplace. So if we don't get people adopting the methods that we have, like a vaccine, et cetera, there's at least a reasonably significant portion of the population that is simply going to continue to stand on the sidelines. So the vaccine and how we deal with this is going to be extremely significant and important. That's it.
Okay, Milt, looks like we have another question for you. Do you see a monetary reset to the gold standard?
No. And the reason I do not is because if you look at the mechanics of what is required to go back to a gold standard, we would have to cut the money supply that is already out there enormously. And the contraction in the economy that would require at this point in time would be catastrophic. Now, understand, I'm answering the question from the perspective of where we are now. I'm not making a value judgment of should we ever left the gold standard. That's a totally separate question. So the answer I'm giving is, as a practical matter, to use a colloquialism, that ship has sailed. And if we try to put that boat back in the dock, it's gonna be painful, more painful than we would ever want to stand.
Okay. Another one here, Kevin, maybe you could answer this one for us. Are there any updates on the Schwab acquisition of TD Ameritrade?
There are, in fact. Within the last couple of weeks, Schwab has received approval for the acquisition from both the regulators and from their shareholders. And TD Ameritrade shareholders have also signed off on it. So I think the expectation at this point is that the deal will close probably within the next few weeks, maybe early September, if not before. And as of right now, they're still saying that the integration period is expected to be 18 to 36 months. So even when the deal closes, there's still going to be probably a couple of years before we start to see meaningful impact on our TD Ameritrade platform and what our clients are seeing as far as their account management. The one question that has not been answered definitively yet is, will Schwab keep their existing platform, or will they adopt the TD Ameritrade platform that we're using today? And I think that's something that they're going to be studying for a while before they come up with an answer there. But for right now, it's business as usual, and it probably will be for quite some time before anything changes. And obviously, as we get more info, we'll share that with everybody.
Okay, that was a much lighter question. Okay, so that's all of the questions we have. How about we take a moment to let someone ask a question in the chat if they haven't been able to yet, and we'll see if anything comes in, and if not, I think that's it.
We have a thank you. That's much appreciated.
We'll give another minute here.
maybe we're good.
Yep. Thanks everyone for joining us.
Okay.